What you are watching right now is not normal trading. This is not a routine dip. It is not just another volatile session. And it is definitely not a harmless move that the market will casually forget next week. War risk is climbing. Oil is reacting like a pressure valve about to blow. And silver is no longer trading like a quiet industrial metal. Three separate stories just collided at the same time. And when that happens, price stops being about charts and starts becoming about survival. The market is still trying to act calm, but underneath that calm, something has already changed. Today's move matters because it tells you the system is beginning to price a world that looks far more unstable than investors were expecting just days ago. Oil is rising because conflict threatens supply, shipping routes, insurance costs, and global confidence all at once. Silver is moving because it sits at the intersection of fear and industry. It is both protection and production. It is both a panic asset and an economic signal. And when those two sides wake up together, you get a market that becomes very difficult to control. That is what makes this moment different. Most people are still looking at the wrong screen. They see candles, they see percentages, they see a commodity chart and assume this is just another round of speculative noise. But that is exactly how big moves hide in plain sight. The crowd always wants a clean explanation. They want one headline, one reason, one neat label. This market is not giving them that, because this is not one story. This is a chain reaction. First, war changes the psychology of capital. The moment geopolitical tension rises, investors stop asking what is cheap and start asking what is safe. That shift sounds simple, but it is not. It changes everything. It changes where money hides. It changes how governments think. It changes what industries prioritize. And it changes how quickly a market can go from orderly to chaotic. When missiles fly or major powers posture, nobody cares about last quarter's valuation model. Nobody cares about a perfectly shaped technical pattern. Capital becomes emotional. It moves faster. It gets defensive. It pays premiums it refused to pay a week earlier. Then oil enters the picture, and that is where things start getting dangerous. Oil is not just another input. It is the bloodstream of the global economy. It affects transport, manufacturing, food, shipping, plastics, chemicals, aviation, electricity in some regions, and overall inflation expectations. When oil begins to rise sharply because of war risk, the entire market has to recalculate the cost of living and the cost of doing business. Every central bank watches it. Every government watches it. Every trader who thinks they can ignore energy eventually gets dragged back into the story. Now add silver. This is where most people miss the real setup. Silver does not behave like a simple fear trade. Gold is cleaner. Gold usually moves when trust weakens. Silver is messier. Silver moves when trust weakens, and when industrial demand starts to matter, and when liquidity conditions get unstable, and when traders begin hunting for the next catch-up move. That complexity is why silver confuses people right before it shocks them. It can stay quiet while the conditions build. Then all at once it starts acting like the market has finally understood what it is. And what is silver in a moment like this? It is a metal with two engines. One engine is fear. The other is function. Fear says war risk is rising, currencies look fragile, real stability is disappearing, and investors want something outside the financial system. Function says silver still matters to electronics, solar infrastructure, advanced manufacturing, defense-related components, and broader industrial demand. So when oil rises because of conflict, inflation risk comes back into focus, and silver suddenly gains support from both sides of its identity. That is why this is not normal trading. The market hates when a neglected asset gets a second narrative. One narrative can be dismissed. Two narratives are harder to suppress. When silver is only an industrial metal, investors can price it through growth assumptions. When silver is only a safe haven trade, investors can compare it to gold and move on. But when war turns oil into an inflation trigger and silver into both a hedge and a strategic material, the old models stop working. And once the old models stop working, price starts searching for a new one. Think about the sequence. Conflict risk rises. Oil jumps. Inflation expectations harden. Bond markets become more sensitive. Central banks lose flexibility. Growth fears increase. At the same time, investors begin searching for assets that can survive policy confusion. That alone would be enough to create stress. But then, industrial metals with monetary characteristics begin to wake up. That is where silver becomes explosive. Because silver does not need a perfect economy to move. It only needs enough instability to make investors question the old assumptions. This is why today matters more than the average market participant realizes. The average participant still believes the world is operating inside a familiar script. A little conflict, a little volatility, a few headlines, then everything settles down. But markets tell you when that script is breaking. They tell you when pricing is no longer about patience. They tell you when participants are repositioning for outcomes that used to feel too extreme to discuss openly. Oil does not spike because traders are bored. Silver does not suddenly gain urgency because nothing is happening. These are message markets. They are saying something. And what they are saying is uncomfortable. They are saying that global stability is more fragile than advertised. They are saying supply chains are still vulnerable. They are saying inflation is not dead, no matter how many people wanted that story to be true. They are saying that central banks may not get the easy landing they were hoping for. They are saying that risk assets have been priced for convenience, while the real world has been pricing for disruption. That gap cannot stay open forever. Here is what most people are still missing. War does not need to fully disrupt global supply to move markets in a lasting way. It only needs to force participants to price the possibility. Markets move on probability shifts, not just confirmed disasters. Shipping routes do not need to completely shut down for insurance premiums to rise. Energy infrastructure does not need to collapse for traders to bid oil higher. Industrial buyers do not need an actual shortage before they start securing future supply. The fear of interruption is often enough to change behavior, and changed behavior becomes changed pricing. That is where silver's real opportunity begins. If industrial users decide they need more reliable access, they buy sooner. If investors decide fiat confidence looks weaker in a war and oil environment, they allocate sooner. If traders realize silver is still relatively small compared with other global markets, they chase harder. Every one of those responses puts pressure on a market that does not need massive flows to move aggressively. Silver is not one of those markets that requires a civilization-sized shift to explode. It requires a moderate shift in urgency. That is what makes it dangerous to underestimate. But there is another layer here, and this is the part almost nobody wants to say out loud. Rising oil in a war environment can trap policymakers. If inflation starts reappearing through energy, central banks lose room to rescue risk assets aggressively. Cut too soon, and they risk reigniting inflation. Stay tight too long, and they worsen the slowdown. That is the kind of policy trap that creates confusion across equities, bonds, currencies, and commodities all at once. Markets can handle bad news. What they struggle with is conflicted policy in an unstable world. Silver tends to love confusion more than people realize. Not because confusion is good in itself, but because confusion destroys confidence in clean outcomes. Once investors stop believing there is a smooth path back to normal, they start diversifying into things that benefit from disorder. Gold gets attention first. Silver comes next, often later, often more violently, and often with far less warning. That delayed recognition is part of the setup. Silver rarely moves in a way that feels polite. It moves in a way that makes people wish they had paid attention earlier. And still, there are people looking at this market and saying it is overdone. They are calling it emotional. They are saying headlines are driving temporary volatility. But temporary volatility does not usually change the structure of multiple markets at once. Temporary volatility does not make oil, inflation expectations, industrial metals, and safe haven thinking start leaning in the same direction. Temporary volatility does not make traders suddenly question whether normal cross-asset relationships will hold. Something more important is happening. The market is beginning to understand that the cost of instability is higher than expected. Look at the bigger implication. If oil remains elevated, the cost base of the global economy rises. That squeezes margins. It pressures consumers. It complicates disinflation. It can slow growth while keeping prices sticky. That is not a comfortable backdrop for most financial assets. But silver does not need comfort. Silver needs tension. It needs a world where people cannot easily decide whether they are preparing for inflation, stagflation, supply stress, military escalation, or monetary confusion. In that kind of world, silver becomes one of the few assets that can plausibly belong in all those conversations at once. That does not mean the path will be smooth. In fact, it almost guarantees the opposite. This kind of market produces violent swings. It produces fake breakdowns, sharp reversals, liquidations, and sudden squeezes. It creates days where the price action looks irrational until the bigger story catches up. That is exactly why so many people get trapped. They expect a linear move in a non-linear environment. They expect a clean breakout in a market built on stress. But major re-ratings do not happen in a straight line. They happen through chaos, disbelief, and repeated attempts to shake out weaker hands. So the real question is not whether the market is volatile. Of course it is. The real question is whether the drivers behind that volatility are temporary or structural. And right now, the answer is becoming harder to ignore. War risk is structural until proven otherwise. Energy sensitivity is structural because the global economy still runs on it. Policy vulnerability is structural because inflation never truly left the building. And silver's strategic relevance is structural because it sits inside real industrial systems, not just investor narratives. Put those together, and you have a market shift that looks much deeper than a headline reaction. Now think about what happens if this escalates further. Oil pushes higher. Inflation expectations climb. Real yields become harder to read. Equities start struggling with margin pressure. The dollar gets pulled between safe haven demand and policy uncertainty. Industrial users start thinking ahead, not because they want to panic, but because they cannot afford not to. In that environment, silver stops being a forgotten metal and starts becoming a decision. That is when attention changes. That is when flows change. And that is when the move can become far more aggressive than fundamentals-based skeptics think is reasonable. The market has seen war before. It has seen oil spikes before. It has seen precious metals rallies before. But what makes this episode stand out is the way these elements are arriving together at a time when the system already looks fragile. Debt is heavy. Growth confidence is uneven. Policy credibility is not what it used to be. Supply chains remain politically exposed. Investors are exhausted from pretending that every shock will be short-lived. That exhaustion matters because it reduces the market's ability to shrug things off. Once participants stop reflexively buying the idea of normal, assets linked to disruption start repricing faster. And let's be honest about another uncomfortable truth. A lot of capital was positioned for convenience, not resilience. It was positioned for cooling inflation, lower volatility, manageable geopolitics, and a gradual return to business as usual. That positioning becomes vulnerable when oil starts screaming that the world is not calm. It becomes even more vulnerable when silver starts behaving like it no longer accepts the old script. Because once that happens, the market is no longer debating valuation alone. It is debating reality. Reality right now is this. War risk is amplifying energy risk, and energy risk is amplifying monetary risk. Silver sits directly in the middle of that chain. That is why this move deserves more respect than the average trader is giving it. It is not just a metal reacting, it is a warning signal. It is the market asking whether the next phase will be defined less by growth optimism and more by resource security, inflation pressure, and geopolitical fragmentation. If that is the direction we are heading, then a lot of assets are still mispriced. Here is where the setup gets even more interesting. Silver remains small enough that it does not take a tidal wave of money to create a major move. That is why small shifts in perception can become outsized shifts in price. If even a fraction of traditional capital decides that silver deserves a larger role in portfolios during an unstable, energy-driven environment, the revaluation can be dramatic. Not because silver is magical, but because liquidity in this market is thin relative to the scale of capital that could eventually care. That imbalance is always sitting there in the background, quiet until suddenly not quiet at all. This is also why silver often moves in ways that feel unfair. People wait for perfect confirmation, but perfect confirmation arrives after the best part of the move. They wait for everyone to agree, but once everyone agrees, price is already higher. They want proof that the world has changed, but markets move the moment enough people decide the old world no longer deserves the benefit of the doubt. That is the phase we may be entering now. Not certainty, not full panic. Just enough doubt to force a repositioning. And doubt is powerful. Doubt makes traders hedge more aggressively. Doubt makes institutions reassess exposures they ignored for months. Doubt makes commodity buyers think about procurement rather than spot prices. Doubt makes investors revisit assets they dismissed as boring or obsolete. The market does not need unanimous belief to change direction. It just needs the erosion of complacency. Once complacency breaks, momentum can do the rest. That is why calling this normal trading is such a mistake. Normal trading is when price is negotiating routine expectations. This is not routine. This is the market beginning to process a world where conflict can reprice energy, energy can reprice inflation, inflation can reprice policy, and policy confusion can reprice hard assets. That chain is not normal. That chain is dangerous. And dangerous environments produce some of the biggest moves because they force the system to reveal what it actually values when stability is no longer guaranteed. So where does this leave us? It leaves us at the start of a very important shift. Not necessarily the end of the story, but the end of the easy story. The easy story said inflation was fading, energy shocks were manageable, geopolitics were background noise, and silver was just another metal drifting between industrial demand and temporary speculation. That version is breaking. In its place, a new version is forming. A version where war matters more, oil matters more, supply security matters more, and silver matters more than the market had priced. That new version carries risk, but it also carries opportunity. Because big opportunities often arrive disguised as confusion. They arrive while the consensus is still arguing about whether the signal is real. They arrive when charts look messy, headlines look noisy, and conviction feels uncomfortable. That is exactly the kind of environment where the market rewards people who understand the mechanism before the crowd embraces the narrative. The mechanism here is simple, even if the market reaction is not. War raises the cost of stability. Oil transmits that instability into the economy. Silver absorbs the consequences through both fear and function. That is the chain. That is why this matters. And that is why today's move is not something to casually dismiss as noise. It is the market adjusting to a world that suddenly looks more expensive, more fragile, and more resource-sensitive than it did before. So do not let the day-to-day swings distract you from the larger message. Price will shake, headlines will compete, analysts will try to reduce this to something cleaner than it really is. But beneath all of that, the signal remains the same. The old assumptions are under pressure. Energy is back at the center of the macro conversation. Silver is no longer sitting quietly at the edge of the stage. And once a market like this begins transitioning from ignored to necessary, the move can keep going long after most people first call it irrational. What changed everything was not one chart and not one headline. It was the collision. War changed risk. Oil changed inflation. Silver changed character. And when an asset changes character in the middle of a geopolitical energy shock, you stop measuring it by yesterday's logic. You start preparing for tomorrow's repricing. Because this is not normal trading anymore. This is the moment the market started telling you, very clearly, that the world underneath the charts is shifting faster than the charts themselves can explain. And if that message is right, then the biggest mistake from here will not be volatility. The biggest mistake will be pretending nothing fundamental has changed.